So I think I may have found the next bubble, but I will admit this is not my area of expertise. Hence, we go to one of our weekly millionaires, Taylor from Life Goal Investments. How you doing, buddy?
Doing great. Thanks so much for having me. I'm excited to talk about this.
So over the last couple of weeks, I have been reading about more and more money leaving the banks. Some of that money goes to gold, Bitcoin, coffee cans, but a lot of it appears to be going to money market funds. I read a stat the other day that kind of caught my attention that $1 trillion, yes, with a T, ended up in money market funds in Q1. So they went from like 4.5 trillion to 5.5 trillion. So my fear is it may become the next bubble. I'm not really sure what a money market bubble looks like. Maybe it's stocks go up and indexes go up because money flows. So you're a 10-year Wall Street veteran. You run a couple of ETFs. I got to ask, am I crazy to think that the money market funds might be a bubble and there might be some trouble lurking behind the scenes?
It's interesting. First of all, that is a massive number. 1 trillion. Well, when you hear 1 trillion, obviously, you know, it's a massive number to begin with, but when you put 1 trillion on just 4.5 trillion to start, that is a massive, massive, massive influx of money. That's, 22% or whatever it is, increase like that.
Yeah.
So we got to understand what money markets generally are. What they are invested in is generally extremely, extremely short-dated, high-quality fixed income.
Okay.
So it's going to be really short, and there have been some significant changes because what happened in 2008 was money markets broke the buck.
Yeah, we were going to go there. So yeah, tell people. Yep.
Yep. So in 2008, money markets broke the buck. And what happened back then was not much different than what, well, hang on, let me just go there. So back then they were invested in very short dated commercial paper, which
Correct.
are 7 to 9 days out, essentially bonds that are extremely short term, that as long as that particular company didn't go under in the next 7 to 9 days, that money was going to be good. And obviously what happened was Lehman Brothers, Bear Stearns, et cetera,
And a couple of companies go bust. Yeah.
They went under, right? They went under. So what you had was money markets, which essentially a promise the NAV is going to stay at $1 and they will not move, was a couple of them ticked down to 97, and it caused an absolute run on money markets. And people said, okay, my money is not safe in there anymore. I'm getting it the heck out. And much similar, but much more pronounced than what happened with the most recent.
And again, you and I experienced that, or at least were around for that. And I remember the morning when that first money market broke the buck, and it was 97 cents. And just like today, where we're seeing money leave banks and going to money market, I think that was the reason people move money markets to banks.
Correct.
And it's my generation's experience remembering money markets as risky. Now, they're not supposed to be, but we remember breaking the buck and all the fear. And that's probably why we left money at banks earning 0 when money markets today are earning 5%. We've only recently woken up to the fact that there's 20x or 50x of the return available in a money market. Hence, we're going the other direction. So it's wild to see it go the other way.
Really well put. Yeah. And so what they did is they changed some of the regulatory environment as to what those money markets can invest in. And so they have become less risky from that time frame. So I don't think that you're going to get some big blow up of the money market product, because I think that, one, again, it's such short dated paper. Two, I think our economic backdrop that we're facing right now is significantly different than that of 2008, when the financial system was literally on the brink of collapse. Yeah. But nonetheless, that amount of money entering one single investment vehicle in a very short period of time can certainly have adverse effect. The government has done their best, and they also did their best and were in Silicon Valley Bank and trying to regulate there. So we'll see what that all means. But they have done their best to make money markets safe. And so hopefully that does come through in spades here. But again, it is very high quality, short dated bonds that are held inside these portfolios as a whole. And that's kind of what they're meant to be. And so far, the market seems to be holding up really well.
Yeah. So if you think all this money,
go ahead. And the other thing I would say about that is they're also seeing the massive influx of assets too, which is not what creates the problem. It's when the money goes the opposite way. that creates the problem. But one thing you can see with an influx of assets is you can see yield compression as demand changes, and then you have yields come down. And at the same time, you also have, over the last couple of weeks here, fixed income yields coming down in general. So that also will drive down money market yields as a whole as well.
Yeah. So let's talk about the other side. So money markets makes total sense. Again, 4.5%, 5%, a lot better than 0.1, 0.2 at the big banks.
Yep.
But now what we've seen is all this money leave the banks, whether it be small and medium-sized banks. 2 weeks ago, the big banks lost money. Last week, the top 25 banks lost, like, I don't know, 600 billion or something, just some crazy number. Or no, it was 90 billion. But still, this is all money that really hurts fractional reserve lending, right? Again, you take in 1,000, you lend out 900. The fractional reserve banking doesn't work when it sees flight of capital. The banks, many banks are insolvent today.
It's so funny that everyone seems to be downplaying this thing. It shocks me every time someone says this is, an isolated incident to a couple banks. Like, everyone that took in money over the past year, put it to work. Everyone being the banks, put it to work in bonds that have lost value. Yeah, and now they're getting
better.
The value.
They're getting better.
They're getting better now, as you've seen a flight to quality and a flight to safety in bonds, but nonetheless, they're still meaningfully lower than they were, a year ago. So it's funny that people continue to be, as I keep saying, Pollyannish about this whole thing, but like the banking structural issues are there, and what you're going to get out of this, which is not, I guess we need it, but it's, at the end of the day, for profitability of banks, it's certainly not a good thing, is you're going to get higher regulation out of this. It has to come, because we can't continue to have this issue play out every decade, which seems to be kind of the pace that we're at.
Yeah, I think there's a couple of things coming to the banks. One is higher regulation, which I translate as an expense. Yep. Also, I think they're going to have to increase.
To be clear, what you're saying there is it gets bled through the consumer.
Correct. Yeah, correct. And their income statement and all of that. But yeah, we pay for it at the end. Also, I think what's going to happen is they're going to have to raise interest rates on the savings to try to keep some of that with them, right? They have to close the gap. I mean, just makes perfect sense.
It's a double-edged sword, though.
Of course it is.
It's a double-edged sword. That is the line that they're going to try to figure out how low can we maintain yields and yet have money not leave? Like, where is that point? Where is that line? I want to get to that line, and I certainly don't want to go any further over this. But it was funny. Wall Street Journal wrote an article on this 6 to 9 months ago, and a buddy sent it to me, and it said, "Why are banks paying so low? Because they don't have to pay anything.
Because they can.
Because they can. They're not going to pay you more than they have to pay you. They're a profitable endeavor. Like they're not a not for profit."
Yeah. But at the end of the day, if all this capital is leaving the banking system, it has to impact lending.
No doubt.
Right.
No doubt.
Credit crunch, whatever you want to call that. And again, I think all of this is helping Powell, and why I feel good about the next Fed rate increase being the last one is I think he's getting a point, basically a point of raise just out of the credit market. It's wild.
And to be clear, a point, he's talking about 25 basis point movements. So
a full 100
of 4 Fed rate hike movements is, and I totally agree with you, Michael. I couldn't state it any better than that. And I think that's why my point in the prior video is that I don't think we get a Fed rate movement in May, because I think there's a lot of time between now and then, and we get a lot of data that shows continued slowing. We got economic data this morning that was not pretty. The ISM, the manufacturing data that gets put out on a monthly basis, showed the 5th straight month of negative growth in the manufacturing index, which was, and we knew it was.
You have the number. Expectations are like 47.1. What did it come in at?
47.5 were expectations. It came in at 46.3. So
46.
It came in meaningfully beneath it. Yeah. So what's interesting is we know manufacturing slowing, but later on this week we get services, ISM services, which that will be more telling, because that has been the one that's been stickier, and the demand for it has been more meaningful. So we'll see if we get, a reprieve. I guess, I don't know if you call it a reprieve, meaning it's a good thing.
If you get something north of 50, that'll be okay.
Yeah. So we'll see what winds up playing out there. But that was an ugly number out of the manufacturing index this morning.
Yeah. Well, since I got you here, and I think the most important number this week comes out on Friday, which I think the market's closed Friday. That's
It
the
is.
jobs number for March.
It is correct.
Expectations 238, I think.
Yeah, I did look at them. The number has slipped my mind. I think you're about right.
So let's
there,
call
though.
it 238. You want to take
Yep.
the over or under?
I'm taking the under.
Really?
I think things
Okay.
have now started to bleed through. I think that the manufacturing data is leading to us to believe that. We'll see. We'll see. What do you think?
Yeah. Well, I think it's interesting because actually I don't know how this survey is calculated, because I am on record saying the Saturday post Silicon Valley Bank is when the world changed, the consumer changed.
Yep.
That was kind of mid-month.
Yep.
So if the survey was kind of there or before, I think it comes in hot. But if it's truly a collection at the end of the month, I think it'll come in low. But just to be different, I'll take the over. I'll take 250, 255.
I like it. We don't like to agree. That's boring.
Yeah, it's just no, the audience hates that.
No,
Oh,
yeah,
man.
it's I totally agree. And it's interesting because it will I don't know what happened. So I guess I could look at data on this. I haven't. So it's Good Friday and the market's closed on Friday. But does that exacerbate the move that happens on Monday that would have happened on
Yes.
Friday? Yeah.
Yes.
Yes.
Absolutely.
People stew on it all weekend. They're like,
exactly.
all right, sell, or buy.
Yeah. I never play in the first 30 minutes. That's where the amateurs are.
Yes,
Yeah.
exactly right. That's
It's
well
pretty
put.
crazy. Yeah. So at the end of the day, you put out a lot of great stuff on your social media handles. What is it? Where can people follow you?
Yeah, thanks so much. Follow us on TikTok and on Instagram at Life Goal Investments.
And stay tuned for bonus episode number 4. We're going to talk about a hot topic. The dollar is dead. Thanks, Taylor.
Let's do it.